now it's time for Ken Watton, who's the lead fund manager for Strategic Equity Capital, works for Gresham House Strategic. Ken will be taking you through about a sort of 35-minute presentation. I'll pick up at the end and we'll do the Q&A. So welcome, Ken.
Thanks, Mike.
It's a bit cooler in your study. Mine's a little bit warm at the moment, so I'll go.
I'm in the office with some aircon, luckily. So
okay, I wish I was. So over to you.
Thank you very much. So it's good to be here, and thanks everybody for joining. I will now share my screen to show you my presentation. So hopefully everybody can see that. So I'm here to talk to you about Strategic Equity Capital PLC, which is London listed investment trust focused on investing in UK smaller companies, which I'm the lead manager. So if I take you through, just to give a brief introduction to myself. So I'm Ken Watton. I head up the public equity investment team at Gresham House, and Gresham House is the asset manager that manages SEC. I also manage a number of other funds at Gresham, including the Gresham House UK Microcap Fund and UK Multicap Income Funds, which are open-ended vehicles. And the consistent thing around all of our strategies is that we try to take a private equity approach to investing in public markets, particularly focused on the smaller end of the public markets in the UK. And I'll come on to tell you what we mean by that. We have good long-term track record in terms of performance across our suite of funds. There's a few awards and sort of ratings that you can see on the chart here. I won't go through those, but Strategic Equity Capital, I guess, is the purest form of what we do in terms of this private equity approach. So we'll talk you through the investment process and then a little bit about the fund and some of the investments that we have within it, and then move on to questions. So just a brief summary of SEC. It has what we believe is a very differentiated strategy. As we said earlier, a private equity approach to investing in smaller public companies. We take a concentrated approach, so the portfolio typically has about 20 holdings, with the majority of the value of the fund in the top 10 holdings. So highly concentrated, high conviction portfolio. We place a lot of emphasis on our research process, doing deep due diligence on the companies we invest in, and particularly trying to leverage our private equity network to help us to do that. And I'll come on to that in detail in a minute. It's a genuinely small cap fund, so we're focusing at the point of new investments into companies that are between 100 and 300 million market cap, so the smaller end of the market. And that's an area we think is particularly attractive because it's structurally overlooked, under research, and therefore there's lots of opportunities which we can uncover which aren't widely known about at the point when we invest. We take a long-term investment view, so typically our holding period is 3 to 5 years, often longer. So we have low portfolio turnover, and we're really focusing on quality companies which we can back for the long term. At Gresham House, we are small cap specialists, so we have significant resource and focus around the smaller part of the market, but in both public equity but also in private equity. So we try to leverage the wider public and private equity platform to get better outcomes for investors in SEC. I took over as lead manager of the fund in September of last year, following a review period after Gresham House won the mandate from a different asset manager earlier on last year. So we're sort of over 9 months into my tenure with the fund, and there's been a bit of portfolio turnover, but we think it's now well positioned to create value going forward. We think we have a portfolio of high quality companies and attractive valuations, and importantly, the trust itself is trading on a significant discount to NAV, which we think offers very good value. So I'll introduce the Gresham House team and the capability of the platform, because I think it's really key to sort of underpin the differentiated strategy that this trust employs on behalf of shareholders. briefly introduce you to Gresham House. For those of you who are not aware, Gresham House itself is an AIM-listed specialist alternative asset management company. At our last trading update for the period to June, we announced that we had 4.7 billion of assets across a number of different strategies. We operate the business within two divisions: strategic equity, which is where I sit, which has strategies in public equity and private equity, and then real assets, which has strategies across forestry, new energy, sustainable infrastructure, and housing. The real assets part of the business is skewed in terms of its client base towards institutional and pension fund investors, although it does have two listed investment trusts which retail investors can invest in, which is GRID, the battery storage fund, and RESI, the shared ownership and social housing fund. Well, I'm here today to talk to you about our equities business, which currently is running at about 1.4 billion out of the 4.7. This shows you what I think is a very well invested investment team in the public and private equity division of Gresham House. So we have 6 full-time investment professionals in the public equity team, which I head up. That's myself and Adam Carnby, who co-manages SEC with me, and then 4 other members of the team. We have support from a very experienced investment committee, which I sit on, but also comprises of Tony Dolwood, who's our group chief executive at Gresham and has had a long-standing investment career himself at Phillips & Drew, UBS, and Schroeder Ventures. We have Graham Bird, who's has a long career in the city, in Cazenove, in investment banking and advisory, as well as being a fund manager at Schroeder Ventures and previously Gresham House. Bruce Carnegie Brown, who's chairman of Lloyd's of London, on the board of Santander, and a very distinguished city to larger company chair and plural career, and Tom Teichman, who's a long-standing venture capital background. That investment committee is integral to the process for SEC, and I'll talk you through that in more detail shortly. We also have a dedicated private equity team of 9 people within Gresham House, and that's important because when we talk about taking a private equity approach to investing in public markets, we do know what we're talking about. We have a private equity business within our division, and the key members of which I've worked with for over 14 years. So the public equity team, or most of the public equity team and most of the private equity team, joined Gresham when we spun out from the private equity firm Living Bridge in 2018. And many of the senior people have been there since then, and we've built the team from that starting point. So we have run public equity portfolios within a private equity environment for a number of years now, and we believe that by combining the capability of public and private markets within the same division and working very closely together, we get significant synergies which are beneficial to both parts of the business, both in terms of our network of people, the insights that we get from the public and private companies we have in our respective portfolios, and also joining up in terms of cross-team working to really sort of focus in and try to build expertise, capability, and network within specific sectors and specific thematic areas where we think there's going to be opportunities to deploy capital across both parts of the business. We have 2 functional experts within the division as well, which span across public and private equity. They are effectively part-time executives who also have some non-executive appointments outside of Gresham. They're exclusive to us in the area of investment. And Hazel and Cameron at the bottom, Hazel Cameron and Tamir Osman at the bottom right of this chart. Hazel has a very sort of extensive and successful private equity career. She heads up our portfolio talent function, which is all about joining up our network and trying to ensure that we can get the best possible people involved in the companies we invest in. In the private equity side of the business, she is recruiting chairmen, CTOs, CFOs, and trying to build high-performing boards in those companies. In our public equity team, and how she supports us, particularly for SEC, really around helping us to find high-quality expert individuals within our network who can help us to evaluate companies, who can help us to potentially get involved in those companies after we've invested. And particularly, she's active on helping us to find high quality non-executive directors that potentially can be added to the boards of our portfolio companies. Tamir Osman is a technology expert, so he's our technology operating partner. He's a very experienced technologist. He had a senior executive career at Microsoft. He was the CEO of Microsoft's business in Turkey, which he grew very extensively when he was running it. And then he headed up their digital transformation consulting unit across Europe, which was advising corporates and companies on their technology strategy and how to implement important technology solutions. So he's, technology, it goes across all sectors. It's an increasingly important part of everything that we do. And so having someone in-house who's got a really sort of deep operator-based knowledge in terms of technology and implementing technology, we felt was strategically important. So we try to use him where we can, where technology is a key driver of our investment case. I've talked a lot about the team, but I think it's important to emphasize we have a very well-resourced team, both public equity and the wider investment team. We have a very experienced investment committee that oversees what we're doing. We have functional experts that we can deploy into our portfolio companies as and when we think that will add value. So if I was to sort of highlight the 3 reasons why Gresham House's public equity business is differentiated from our competitors, I think it's really epitomised by this slide. So we are genuine smaller company experts. That's all we do. That's where we've been running money for well over a decade in public equity, and it means that our portfolios are genuinely differentiated from our competitors because we have high conviction portfolios and they're in smaller companies. Typically, they have very low correlation with other funds that you could invest in the same sectors. We have a very clear and disciplined process. We're very rigorous about what we do and don't invest in and the criteria that we're looking for. And that process has been built up over many years as part of a private equity firm. Really is focused on the fundamentals of the companies and taking a long-term view about how they're going to be successful. And what that's delivered across our suite of products is not just good returns, but also very good risk-adjusted returns, low volatility. We score very favourably against our competitor set on things like downside capture and sharp ratio and such like. So we think our portfolio, which is designed to mitigate risk, works. Then lastly, our powerful network. I mentioned the private equity network that we've built up over the last 14 years. This really underpins our research process. So when we're trying to generate ideas for new potential companies to invest in, when we're trying to evaluate those companies through our due diligence process, and also after we've invested, we try to leverage that network of experts that we've got, where we can find people who are genuine operators that understand the business that we're looking at, not from financial markets and a fund manager perspective, but from an actual genuine operator perspective. We can test our investment judgments against those experts to ensure that we're sort of making the right judgments about what we're doing and really building conviction in investments that we're making. We can also deploy that network potentially to help those companies on the way through. We're actively engaged investors, and we think that by introducing companies that we invest in to high quality individuals or high quality firms that can advise them and help them, that's likely to result in better outcomes for all shareholders in those companies. And just to bring the private equity network to life a little bit, and what we mean by that is a whole host of different individuals and businesses that we've interacted with, that we have very strong reciprocal relationships with. People, chairmen, special advisors, situational experts, non-executive directors, but also specialist consultancies, mergers and acquisitions boutiques, and past and present investee company executives and non-executives who have a whole host of operator and sector-based knowledge and expertise that can be brought to bear on our portfolio companies. We think this is very different. Very few, if any, of our competitors would have something equivalent to this, and particularly in the public equity space, at the smaller end of the market, where you're often investing in niche companies. Having this network is a really, really strong competitive advantage in terms of trying to get under the skin of those businesses and evaluate them properly. I'll just talk a little bit about the investment process and investment strategy. So Strategic Equity Capital PLC, SEC, employs what we describe as our strategic public equity strategy. So this is taking a private equity approach, but being very concentrated and taking advantage of the closed-end structure of the fund in terms of the liquidity benefits that gives you to take big bets on a small number of companies, but we have very high conviction. So we try to take influential minority stakes. We think that taking, being one of the larger, if not the largest shareholder in a company, gives you a platform for active engagement. It means that the companies engage with you on key strategic issues. You can be potentially the cornerstone investor in fundraisings if they're looking to make acquisitions or to invest to grow their businesses. And you have, and this is very topical at the moment, you have some influence in a situation, for example, when a company has a takeover offer, as to whether or not that will happen and also what the price is. So we focus on businesses we think are high quality, but where we believe the long-term opportunities and prospects of that company are being undervalued by the market. So we like quality, we like growth companies, but we don't like quality and growth at any price. So we're very disciplined on valuation. We place a lot of emphasis on due diligence and really using our network and our research to identify the value creation catalyst for a company and having a very clear thesis as to how that's going to play out. And then where we can make introductions or engage with management teams to help make those happen, we'll do that. So that's strategic public equity as a strategy. Our investment process is modelled on private equity, and as I said, I mentioned before, I spent 12 years running public equity portfolios within a private equity firm, and so I think I have a pretty good sense for how that works. And I think one of the key elements of that is operating as a team, so making team-based collective decisions rather than one individual sort of staff fund manager calling all the shots and making all the decisions. We think that you make better decisions as a diverse team and sort of people with different skills and perspectives, and that leads to better investment outcomes ultimately. So the investment process involves writing an initial investment one-pager when we come up with an idea. That one-pager will be discussed as a team. That will then evolve if we decide to proceed into a preliminary investment report. That report will be socialised with the investment committee, which is populated, as I said earlier, with both internal but also external non-executive members with significant experience in industry and in investing. And that investment committee will then debate the investment proposition, decide whether or not we collectively believe it's an attractive prospect to move forward with, and then opine on the due diligence streams that we're going to follow. And we particularly focus our due diligence on the key judgments that we're making as an investment team, and try to use experts to validate those judgments and to really focus on being as efficient as possible at that time. Come up with an equity value plan and a final investment report, and that final investment report is signed off by investment committee, and then we make the investment. Investment committee are involved throughout the journey of the investment, obviously when things change, but also in terms of trying to ensure that wherever we've got expertise and knowledge and can add value to that business, that we formalise that and we make sure that we actually do it, and we understand how that's going to contribute to the value creation of that business. And then we see that through to exit. And sometimes we exit through the market, but often our exit will be through a strategic sale of the whole company. In terms of how we think about segmenting an investment case, this slide gives you a very high level view of how we build conviction. So we segment the investment case into 6 sort of key components. Those form the basis of our investment papers. 4 of them are qualitative business factors and 2 of them are more quantitative. We really focus on the management team, and particularly very keen on governance and alignment of interests around the management team. We focus on the strategy of the business and how that dovetails with shareholder value. Company's market position, its competitive advantages, why they're sustainable, and why they're going to win over the long term. And then the company's genuine addressable market, with their capability and their capacity, what's the realistic growth prospects for that business. So those are the qualitative factors, business factors, if you like, the business fundamentals, and then there's also financials and valuation, which are more quantitative. We score each company out of 10 on these factors, and then those scores are amalgamated to give us a conviction score out of 10 for each of our investments. we'll then use that to rank the investments within the portfolio. And ultimately, we're trying to put the most money, the biggest weighting within our portfolio against those ideas where we have the highest conviction. So it's a simple, but we think effective framework. And then SEC, as I said, because we're taking bigger stakes in a small number of companies, that gives us a platform to engage with the management teams on things we think are important for long-term strategic value for the company. And I've listed some of them here on this slide, but our philosophy across our whole division is really about actively engaging with the management teams of the companies and the boards of the companies that we invest in. And that's the same whether we have a 0.1% stake or 25% stake in the company. We have the same philosophy, but clearly the strategy of SEC is specifically to take high conviction bets in a small number of companies, and when we do that, we take potentially material equity stakes in those businesses to help that. Where we can do that, we then try to engage with the businesses on the key strategic direction of the company. Where we think there's obvious strategic value creation opportunities, then we will sort of engage with the boards to articulate that. We engage on things like board composition. We really feel strongly about trying to get the best possible combination of people around the boardroom table to give diversity of thought and add the experience and expertise in particular areas that support the strategy. And we're active in terms of using Hazel, our head of talent, to introduce high quality individuals where that's relevant. We place a lot of emphasis on long-term management incentives, so we try to engage heavily on long-term incentive plans in order to ensure that they are properly aligned with our interests as shareholders and are properly rewarding strong outperformance and not rewarding mediocrity. I think we're very active on that sort of area. And then we also, where it's relevant, we'll make key introductions from our network. And that's not just individuals that can go on the board, but that might be specialist consultancies that can help the company to revamp its digital marketing strategy, or an M&A boutique who's bought and sold lots of businesses in their sector who can help them to find accretive acquisitions, or indeed potentially help them to sell the whole company if that's the best way of realizing value. So we engage on a number of different issues. They're very different depending on the different company, different situation. And we believe that not only can that add value, but also it can risk mitigate in certain situations. It wouldn't be an equity or probably an investor presentation if we didn't mention ESG. I guess that our take on ESG is that sustainable investing is a critical part of Gresham House Group's long-term strategy and its proposition as a business to the stock market. So Gresham House has published its own 2025 strategic objectives, and one of those is to be seen as a leader in sustainable investing by 2025. So every part of the business, all the investment teams have to support that group of objectives, and the public equity part of the business is no different to that. I think SEC as a fund is not explicitly set out to be an impact fund, so we don't have explicit ESG objectives that investors have bought the fund specifically for. However, our process and the way that we invest is very compatible with sustainable and ESG investing. I think we are particularly emphasise the governance component of ESG, because we place a lot of emphasis on engaging with boards, trying to create high-performing boards, and focusing on culture, governance, and alignment of interest. But the environmental and social factors are increasingly important. I think that's both in the context of sort of reviewing the risks through investment. Are companies on the right side of the direction of travel on environmental and social issues? But also increasingly, we think there's a really strong opportunity to find interesting growth companies that are benefiting from being positioned effectively on the right side of the long-term trend towards sustainability and ESG. So we've got a number of investments in the portfolio that we think can benefit from this structural sort of growth drivers in the overall market around ESG. As I said at the beginning, this is a concentrated portfolio, so we typically have about 20 holdings. and at any given time, the majority of the value is in the top 10 holdings. So as of the date of this presentation, almost 70% of the NAV of the fund is in the top 10 holdings, and you can see the logos here of the top 10. I won't go through all of them in detail, but I'm happy to take questions on individual companies after I finish my presentation. But I will talk through two names in particular, just to give you a flavour of how we think about and what we like. So these are the two companies, Medicare and Inspired. Medicare, which is currently the largest holding in the portfolio, is an outsourced teleradiology business. So it's in the healthcare sector. It's a growth company, albeit the growth was temporarily interrupted last year during COVID, but it has had a very strong track record since it listed a few years ago, delivering double-digit earnings growth. Its main or core business is providing outsourced radiology services into the NHS to support both out of hours and also sort of excess capacity shortages of trained radiologists within hospitals. So supporting routine procedures and more acute issues in out of hours times. And then they've also more recently made an acquisition of a business called RadMD in the US, which is providing teleradiology services into the clinical trial process. One of our big sort of conviction investment themes that spans across our both public and private equity businesses at Gresham House is this area of pharmaceutical outsourcing, particularly the use of data and technology to support the drug development and sort of other clinical processes. And Medicare sort of has pivoted its core expertise into that sector with this acquisition, and we think there's big sort of structural tailwinds to that market. So Medicare, very well positioned business, a leader in the UK, really interesting growth drivers around it, but also a very strong opportunity for the business to invest in technology and to partner with technology companies to improve the efficiency of what it's doing and also to improve the effectiveness of what it's doing, which we believe can be hugely beneficial and can actually compound its position as a leader in that market. Inspired PLC is quite different. So it's an energy-focused consultancy business. It offers services to corporates around sort of helping them to optimize the procurement of energy, so helping them to buy better, buy more effectively, get the best deals relative to their usage, and particularly it's focused on higher energy users and corporates and multi-site operators. It then has a business which is actually helping going into those businesses and running projects to optimize the use of energy and ultimately to help businesses to save on their energy usage, supporting their carbon reduction plans. And then it has a technology, software and ESG data business, which is ultimately helping either businesses or investors to score and understand the ESG credentials of either supply chain or their investee companies, which we think is leveraging the same core data that they use, the same capabilities, but really playing into a trend which is that people increasingly need to be able to demonstrate to their stakeholders their credentials in sustainability and ESG. And as I mentioned earlier, this is a real sort of area of focus and expertise within Gresham House as a wider business. And Inspired is a great case study to show how not only is it something that people need to do because their investors or their customers are demanding it, but also there can be a real opportunity to deliver revenue and earnings growth as a result of that. So that's a very quick summary of two of the companies we like. Both of them we think have significant upside potential over the longer term, both of whom, in both cases, we are the largest investor in the company, and therefore we believe that position gives us an opportunity to engage with the management teams and the board to try and support the long-term value creation that we can see, and that will be to the benefit of SEC shareholders. I'll just finish my sort of formal part of my presentation by talking about sort of view of the market and outlook. I think the first thing to say is that the smaller end of the UK small cap market we think is a really attractive place to invest, and we think that's a structural sort of there's a structural opportunity in this part of the market. So there's a large universe in small cap, 1,500 companies or so in the newest smaller companies index plus AIM. So we can be extremely selective, particularly in a fund like SEC, which is highly concentrated. Just to choose the highest quality, best opportunities for the long-term value creation. This part of the market is inefficient, even more so since MiFID II came in. Research coverage of the small end of the market is pretty poor. I think on average, companies under 250 billion have 2 analysts that cover them, and if you go below 100 million, then it's usually 1 or even none. So there's a really big opportunity for those fund managers who have the resource and capability to do the research themselves, to find uncovered sort of really attractive opportunities that other people may have missed. Because of that, this part of the market typically trades at a discount, and that discount is there throughout almost all of the market cycle typically. So we think there's not only are there interesting growth opportunities, but there's also interesting opportunities to buy growth at significantly discounted valuations versus larger companies. And then the last thing, which is very topical at the moment, I'll come on to a bit more, is this part of the market often attracts mergers and acquisitions activity and takeovers, and private equity and trade buyers look at this part of the market and see high quality businesses which potentially bolt-on acquisitions for. So we think it's structurally attractive. We also think that now is a very good time to buy. So even though we've had a strong market rally and small caps have performed well, certainly since Q4 of last year, it is still the case that despite that recent rally, UK equities look cheap relative to other developed world markets. So the chart on the left-hand side is shows the UK versus Europe and versus the US. And actually, despite the recent rally, the UK is still trading at, and this is on a sector weighting adjusted basis. It's trading at pretty much 30-year lows relative to the US market. Now you might have a view that the US market is expensive, but it's never been more expensive than the UK. So, or not for decades. So we think that means the UK is structurally looks interesting, and then within the UK smaller companies are trading still at a material discount to their larger peers. And whilst that has recovered a bit in recent months, it's only at the depths of the COVID sell-off last year, post the financial crisis in 2008, 2009, and in the aftermath of the dot-com crash, are the only times when UK small caps have looked cheaper relative to larger companies. So we think UK is cheap and UK small caps are particularly cheap, and when you layer on the structural opportunity, particularly in the smaller end of small cap, we think that's there's great opportunities here at the moment. And COVID has created a big discontinuity in the market. Sector recovery has been very uneven. So even though there's some pockets of overvaluation in certain areas of the market, we still think there's great opportunities to find high quality businesses that have good long-term prospects that may have been impacted temporarily by the COVID and lockdown, but where we believe that as we recover, we will find that we've bought them at very, very attractive prices if we buy them today. And we're not the only ones who think that. So I mentioned the takeover activity earlier on. I think this is an interesting slide. It won't have escaped most of your attention. I'm sure that there's been a spate of takeover activity in the UK public markets across the market cap spectrum over the course of 2021. I read some research from Liberum, one of the stockbrokers, that as of August, the UK had surpassed the level of takeover offers for I think since 1999. So there's a huge number of offers, and you're seeing an increasing number of actual bidding wars in public for public companies. So that I think demonstrates what I was saying before about the structural undervaluation, but also the current undervaluation of the UK market and UK small caps in particular. That more sophisticated buyers like private equity firms and trade who have very clear strategic and sector knowledge are finding attractive opportunities to buy UK small and mid cap companies. And SEC is a concentrated fund, but we have had 3 takeover offers for portfolio companies over the course of this year so far. 2 of them have now happened, and we have exited, and one of them is rebuffed, and we were involved in the discussion with the management team about that, and continue to own it. So Equities, the share register and the sort of back office administration business, was taken private by a US private equity firm. Proactis, which is spend analytics and spend management software player, was taken private by Pollen Street Capital, which is a UK private equity company. And then IDOX was actually bid for by an overseas trade buyer. But we and another major investors supported the board, who believed that the offer that was on the table was too low for undervalued the long-term prospects of the company. So the management team didn't recommend the offer, and we felt that was the right thing to do because we think it was good long-term upside in that business. So that brings me to sort of closing remarks before we go to questions. I think if you think about the outlook for the UK market, we've had a very strong market recovery from COVID, and hopefully now the economic recovery is well underway as well, with the vaccine penetration supporting that in the UK. But I do expect there to be some bumps along the way. It's not going to be a straight line recovery. I think we still haven't seen some of the second order impacts of the COVID crisis playing out in certain sectors, and as government support starts to be unwound, you'll see discontinuities come to the surface. I think there are major geopolitical and macroeconomic uncertainties, and shouldn't underestimate the fact that current market consensus forecasts have been struck in a very uncertain environment. So I think the opportunity for profit warnings, both positive and negative, so companies that have been too prudent and then managed to significantly beat expectations, and companies that have been over optimistic about the pace of recovery and then sort of hit a speed bump, and that affects share prices. So I expect all of that to really drive significant market volatility, both at the overall market level from time to time, but also at the sector and specific company level. And that's a challenge for a fund manager and for a long-term investor like SEC, but it's also creates significant opportunities for attractive long-term opportunities to be valued very attractively in the short term. As I said before, we think the valuation environment for UK small and micro-cap companies is really attractive at the moment. There is a structural opportunity, but also at the moment it's very attractive on a relative basis. And so we're very focused in consistently applying our private equity approach to public markets, taking a really fundamentally focused, deep due diligence approach to evaluating companies, and then taking a very long-term view, and then backing those businesses, taking a material stake, and then trying to leverage our network and our expertise to help those businesses to create value over the long term. So with that, I will stop my presentation, and I will pass back to Mike to sort of coordinate in terms of questions.
Thank you, Ken. And we've had quite a few questions coming in, so I'll get through these as briefly as I can. One here on your shareholder base at the moment is top of the list. 69% of shares are held by the top 10 shareholders. And just a question whether this is a good or a bad thing in terms of individual investors, and does this create some volatility or maybe stability in the NAV discount?
So you're absolutely right. The question's correct. We have a relatively concentrated shareholder register with SEC, and have two sort of large institutional investors in particular. And I think that there are pros and cons to that. I think we are sort of actively engaged with our larger investors, and we believe they are supportive and that they understand, I guess, the opportunity with the strategy. So they believe that the investment process is a differentiated and attractive strategy. They believe that the UK market and the UK small caps in particular, there's an attractive valuation opportunity. We would certainly argue, and hopefully they support the current portfolio that SEC has is an attractive, high quality portfolio of assets which are undervalued relative to their long-term prospects. And then on top of that, the trust trades at a meaningful discount to its NAV. So you're effectively getting a triple discount. You're getting the market discount, the portfolio discount, and then the NAV discount on the trust. So that's why some of the bigger shareholders have taken very significant positions. But the shares are still relatively actively traded, and I think from a retail investor's perspective, it is certainly possible to buy shares at the current discount, which we hope will be able to narrow in due course with performance and marketing and more interest being taken in the trust.
Okay, well, just following up on the discount, it's around 14% at the moment, and comment here from someone that's a no-brainer, then we should be buying it, but I guess that's their own personal view. Given the situation, why is it that the discount continues at that kind of level? And also, can you perhaps factor in your response something around the plans you have, I think it is for next year and for 2024, to buy back shares under certain conditions, and just how that all factors into your view of how the discounts you're expecting to manage the discount and why over the next couple of years.
Yeah, so I think the discount is clearly an important issue which the board, Gresham House's manager, and I'm sure most of the shareholders are sort of focused on trying to address. And why is the trust trading at a discount? Well, I think partly it's been a function of historical performance and historical issues with the shareholder base of the trust, and kind of question marks around whether it would continue to operate. And there was a vote in March where shareholders voted decisively to continue the operation of the trust after some shareholders sort of requisitioned a general meeting to consider a wind-up. So shareholders support the continuation, but the noise around that has probably not been helpful to attract sort of marginal new buyers to the shares. That's now behind us. I think you referenced the tender offer activity which the board has announced. So the board, we believe that fundamentally the best way to bring in the discount over the long term is to deliver strong investment performance, and we believe we've put the right things in place. I've got involved 9 months ago, and Gresham House, we collectively did that and got me involved because we felt that the experience and track record that I could bring to this, and the ability to join up the strategy of SEC with the private equity network that we have across the wider Gresham House business would be a real sort of game changer in terms of the application of the strategy. So we put those building blocks in place, but obviously it takes time to feed through into performance, although it's been good so far. Actively promoting the trust, coming out and taking the time to talk to groups such as yourselves and tell the story and get people interested. I think the fund has been sort of under-marketed historically. But then, from a structural point of view, the board has also recognised that this is a key strategic priority, and therefore it's important for not just the manager to do the marketing and to try and drive performance over the long term, but also to send a signal to the market that the board takes it very seriously. So we have 2 tender offers. One which will be around the time of the AGM next year, which is likely to be November 2022. Will be contingent on the discount. So there will be a tender offer to buy back up to 10% of the trust at a 3% discount to NAV at that point. And the trigger for that is if the discount to NAV is wider than 8%, then that tender offer will be triggered. So that's signalling that we're trying to drive the discount well into single digits. And then the second tender offer is a longer one, so that's a 3-year tender offer from June of this year, and it's linked to performance. So there'll be a 15% tender offer at a 3% discount if the performance of the trust in NAV terms lags the FTSE small cap index, excluding investment companies, which is also the benchmark that the fund has for its performance fee. So that's recognising that if we don't outperform the market, then there's an opportunity for liquidity for investors. So I think all of those things together, the performance, the active marketing of the trust plus the tender offers, I think, is a package of measures which we hope will over time will bring in the discount.
Okay, thank you for that. We have another question that, well, it's a sort of comment really that that may be one of the reasons why the discount remains quite large. It's perhaps you're one of the few remaining investment trusts that still has a management performance fee. And then I think there's another question just down below related to that. How do your total fees compare to similar trusts? So could you just talk us through that briefly at this stage?
Sure. So the annual management charge on the trust is 75 basis points, which puts it sort of in line with the kind of broad average for open-ended funds, despite the fact that this is a sort of resource-intensive and specialist strategy. So, and if you look at other sort of more specialist, kind of, I guess, concentrated, more actively engaged equity funds, they typically have higher sort of recurring fees, 1% plus. So the kind of direct peer group that we might compare ourselves against typically have a higher fixed fee. And also the types of trusts that are engaging in something similar to the strategy for SEC also typically do have performance fees in the same way as private equity funds would do. So typically a private equity fund would have recurring fees plus performance fees to try and align the long-term outcomes with sort of positive outcomes for investors. This trust does have a performance fee. It's based on a rolling 3-year compound 2% outperformance of the FTSE small cap index plus investment companies, but also subject to a high watermark. So once the performance fee has been paid, no further performance fee can't be paid until we've exceeded the sort of NAV or NAV per share that previously triggered one. The performance fee is capped, so the trust cannot pay more than 1.4% in total for the fixed and variable fees if the performance fee is payable. So we think that should a performance fee be triggered and the outperformance having been delivered to investors, that most of them will be reasonably happy that performance fee is incurred, because they would have done well if that does happen. And I think it reflects that, from my perspective, that it means that we as manager are highly aligned with driving performance and not just trying to scale the trust without regard to performance.
Mm-hmm. Okay, thank you. We've got a couple of questions about your portfolio. Sorry, one of them just jumped out of got usurped by another question. Maybe we'll start with this one. 38% of your investments were in companies with greater than 300 million market cap. That was from the December 2020 report. And how does this tally with the strategy to invest in small market caps under 300 million?
Very good question. So when I took over as lead manager of the trust, one of the things I said to investors at that point was that we weren't going to sort of radically change the portfolio overnight, but we would evolve it over a sort of 6 to 12 month period. Obviously, we're quite reasonably advanced in that now, and we would gradually reduce the average market cap of the portfolio, which was significantly above 300 million at that point when I took over. And so what we've done progressively has been to take profits and exit some of the larger market cap holdings that the trust had when I took over, typically ones which had done well and where we'd made good returns, and then recycle that capital after we've made those divestments into companies that are in that sort of 100 to 300 million market cap range at the point of investment. So we have done that, and the weighted average market cap of the portfolio has fallen since we took over, even though the market has gone up and the portfolio value has gone up. So what we're saying is that not that the average market cap of the portfolio will be below 300 million, but that each company, when we invest in it to begin with, will be in that bracket, because that's the area, the size that the trust is at the moment, where we think there's an attractive opportunity set and the structure and the valuation that I mentioned in my presentation, but also that we we have a good shot at getting an influential equity stake because of the size of the company relative to our position size, and then that it gives us the platform to engage and hopefully to add value along the way. At any given point in time, the average market cap is likely to be above that level because the thesis will be partly played out. So if we invest in a company that's 200 million at the point of investment, we hope that that company will be worth 400 or 500 million by the time we exit. And so if we're depending on how far advanced we are in the thesis at any given point, there'll be some companies in the portfolio that are at higher market caps because they've done well. So hopefully that explains the kind of, if you just take the straight average or the proportion there will always be a proportion which are above that level because we hope they will anyway, because if we've done our job properly, they will have grown in value from the point we invested. Okay,
thank you. Yeah, that makes sense. A specific question here, because you raised Medicare in your presentation. One of the members wants to know, given that the Medicare shares have gone sideways for 4 years, are they undervalued now, and in your view, and if so, why?
Yeah, so Medicare is another stock in the portfolio which I inherited when I took over, and having gone through a very detailed review of the portfolio prior to sort of becoming lead manager, Medicare was actually one of the ones I was most excited about, and so we have significantly added to our stake since I've been involved, and we're now the largest shareholder in Medicare. So that tells you that I believe that it is undervalued, that the long-term prospects are good. I think the business has grown its revenue and its profits significantly since it IPO'd. But I did not invest in my other funds prior to being involved with SEC. I didn't invest in Medicare at its IPO, and whilst we looked at it a few times, we didn't invest in it sort of subsequent to that either. And one of the reasons was that the market expectations that were set at the time of the IPO were very ambitious. And so the company has unfortunately got itself historically into a position where it had it'd grown very nicely. And if you just looked at the actual financial profile and growth rates of the company in isolation, you'd have thought this company's done brilliantly. But because the market expectations were set probably too aggressively at the IPO, it managed to miss its expectations and therefore sort of progressively disappoint the market. And so the reason why, as your question puts it, the stock's gone nowhere for 4 years, it's partly been a result of the market losing confidence in its ability to deliver. That has resulted in a change of chief executive, which happened about 2 years ago now, and we think very high quality individual, and we've extensively referenced him, Stuart Quinn, through our private equity network, and he's a person who has run a number of private equity backed businesses in the past, so we've got some very good touch points on sort of referencing his quality. And it's a business which we think is very well positioned, particularly to use technology and its market position to really drive sort of long-term growth and long-term shareholder value. There's also an opportunity for it to recover earnings which was subdued as a result of COVID impacting the NHS's ability to do some routine procedures which Medicare are involved in. So there's a sort of recovery and then long-term earnings growth story here.
Okay, thank you. One here about some of the similarities between your approach in SEC and Stuart Widdowson, who is now manager of Odyssean Investment Trust and was a former manager of SEC. And the question of whether it would make sense just to merge the two trusts to get some more critical mass needed to generate better liquidity. I have no idea. Is Gresham? I assume Odyssean is independent of Gresham at the moment, so that wouldn't be a.
Yeah, Odyssean is nothing to do with Gresham, no.
No.
There is a corporate history because Stuart Widdowson was the manager of SEC, as the question points out. When it was managed by the previous asset manager, which we won the mandate from, but Stuart left prior to that. So on paper, the strategies are very similar. So they are both setting themselves out to be concentrated funds in a closed-end structure and being actively engaged investors and taking a private equity approach. And Stuart, like myself, has sort of formerly worked in a private equity firm. So I think Stuart's a very good manager. He's got a good track record, and we have on paper a similar strategy. What I would say is that Gresham House has a very well invested platform. As I tried to sort of explain during the presentation, we have a significant team of public equity investors that are supporting SEC. We have a team of private equity investors that work very closely together to hopefully the benefit of all of our sets of clients and all our portfolios. And then we have the functional experts, the investment committee, and the network that sits behind that. So, I'm not going to sort of say anything else positive or negative about Stuart and Odyssean. I think they've got a good track record and a good following. But what we do is leveraging a very well invested infrastructure to try and hopefully the track record that we have at Gresham House and I have in various of the other funds that I manage and have done for a long time, we can apply that to SEC to the benefit of SEC shareholders. Okay. And as for the idea of a merger, I can't really comment on that. That's for the board to opine on.
Yeah, understood. You have a sister fund called Gresham House Strategic. One of the members here is suggesting that bigger shareholders in SEC may be affected, their attitude may be affected in terms of the large discount and the issues also surrounding GHS. So is questioning whether it's a stable vehicle for investing long-term in small caps, i.e. SEC, I believe. I guess you're not going to agree with that particular statement, so don't surprise me by doing so. But I wondered if you could just perhaps comment on GHS, and they seem to have quite similar approaches. So it seems a little odd that you've got two funds in the same organization now that are kind of doing the same thing. Is there any sense of having to?
I think the trusts are, so they are both applying our strategic public equity strategy, which is the private equity approach to public markets. So both of them are trying to do that. I think the distinction between the two of them is really on the size of the companies that they invest in. So typically, Gresham House Strategic is investing in companies that are below 100 million at the point when they invest, and Strategic Equity Capital is investing in companies between 100 and 300, and then see that we hope they grow. So that's how the two trusts are segmented. So they both have independent boards of directors. There's an investment committee oversight, and they have different lead managers. So I am not managing Gresham House Strategic on a day-to-day basis. Albeit the wider team is sort of very work closely together to ensure that we have a rigorous process. Should they be together? Well, again, they have separate shareholder bases. They have separate boards of directors, and it's not in my gift to influence that, even if I have a strong view on it. To the previous part of the question. What's happening with GHS, and it's in the process of undertaking a strategic review of the trust, and that's ongoing, so I can't really comment on it, but that has nothing to do with SEC, and I'm not directly involved. So I do believe SEC is a stable platform. We have a well invested team and platform at Gresham. I've only just got involved 9 months ago. And we believe we're making good progress, and the shareholders of SEC decisively voted in favour of continuation only in March of this year. So we think we're well set.
Okay, thank you for that, Ken. Look, there's 4 questions here. I don't think we're going to get through all of this because we've overrun the time. So just one quick one: do you or your team own shares in SEC at the moment?
Yes, absolutely. So both myself and kind of key team members have a material part of our personal sort of investable capital in the vehicle, and Gresham House itself has a 5% stake in the company as well.
Okay, all right. Ken, thank you very much for that. I think at this stage we should call it quits, and it's getting on for 6:05. So thank you for your time, okay. And wish you well with the re-engineering of the trust, and definitely keep an eye on how things are going over the next year. Right. So.
And just if anyone has follow-up questions which haven't been answered, then if they wanted to sort of send them through to ShareSoc, who can pass them on to me, I'm happy to.
You'll be happy to answer them. Great, that's fantastic. We will do that then for the ones that are remaining. Okay. Thank you very much, Ken, and enjoy the rest of the day in your air-conditioned office. I'm very jealous.
Thank you. Thanks very much, and thanks for having me. Thanks everyone for attending.